We are half an hour away from the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning. Traders look ahead to China's low prime rates while assessing prospects for the PBOC's biggest policy overhaul in years.
Now, Chinese car makers reportedly urging Beijing to slap a 25% tariff on EU-made cars in retaliation for their tariffs. We look at other products that could be in the crosshairs of these trade tensions.
And tensions flare in the South China Sea with the Philippines demanding compensation after a clash this week in disputed waters. All right, take a look when it comes to the Thursday morning action. We didn't get that sort of tailwind from the U.S. given that they were closed overnight. So certainly the European side of things, there were still a bit of wobbles in that bond market here. The EU really giving sort of a warning to the likes of France as well as Italy when it comes to those budget deficits. So that certainly lifted a little bit those yields when it comes to oat bunds. And you take a look at what oat futures are doing here right now. We're still in the red. So that's what's leading kind of this bond market here this morning. And you are seeing those treasury markets in Japan also seeing yields tick higher in the 10-year yield at 4.24, Australia as well as in Japan. So a little bit of sell-off in bonds here this morning. We're watching very closely that Kiwi as well. Originally, we did see a bit of a pop after they did exit out of a recession in the first quarter, but we've pared back a bit and so far this morning here. We take a look when it comes to stocks, though. We're taking a bit of a breather, right? So we didn't get, of course, that sort of NVIDIA boost like we did the previous session, but you take a look at how stocks are. We're still around, I think we did hit a 3-week high, and that's very close to those 2-year highs for the MXAP. So we're just taking a bit of a pauser here today. U.S. futures are still punching higher, so we'll see how things fare out when Wall Street reopens. But certainly you're not seeing a whole lot of catalysts out there here today. The Nasdaq Gold Dragon didn't do a whole lot either. We're watching TSMC, though, so I think it's been 3 banks that have basically lifted their price targets for the stock here. The ADRs this week had actually surpassed the likes of Berkshire Hathaway. So I'll continue to watch, of course, this rally when it comes to TSMC. Looks like we are also hitting the pause button in Taipei here this morning. But you take a look at when it comes to the tech space, obviously that's still very much in focus here today. We also have that loan prime rate in China as well. Nasdaq Gold Dragon didn't do a whole lot here, but you're watching very closely, of course, what goes on in these Chinese bonds, because once again, bond futures hit another record yesterday. And that's really despite, Dave, what we heard from the PBOC governor yesterday, talking about maybe this new toolkit of buying and selling Treasury bond futures. And certainly that's one thing to watch here, this whole QE aspect. They're not calling it that. And I think the bond market wasn't too excited by that so far. But you take a look at when it comes to the Chinese 10-year yield. We're at 224 levels here right now. And we did see a pretty decent rally in stocks. I believe 8 shares had one of the best days we've seen in months.
Yeah, 3.5% move up yesterday. So we're looking at whether we get a day 2 of that rally. Early going suggests, Yvonne, we won't get that at the open. To your point, a 3-week high too on volumes on the Hang Seng China Index. So, the price move yesterday did have some volumes behind it. Where you're not getting volumes coming through is the onshore market. That, in fact, on the CSI 300 hitting the lowest volume total going back to the start of this year. Other things we're tracking, so we have jobs numbers coming out later today out of Hong Kong. Of course, it's day 2 of the Lujiazui Zui Forum in Shanghai. Loan prime rates in a moment. Of course, the premier is also on a visit to Malaysia, and among other things there as well. So, yeah, we're looking at some of the AI plays. So the big names yesterday, SenseTime, Hardware, Lenovo did see a massive pop. Financials, insurers, brokers also caught up in yesterday's rally. We'll see if we get day 2. But ahead of that, of course, we have some interest rates, loan prime rates to talk about, give us something to talk about at some point this morning.
Yep, so Chinese banks are expected to keep their loan prime rate unchanged for a 4th straight month in a row when they fix the benchmarks in just a few minutes. For more, we're joined by our China correspondent, Min Lo. So you're still seeing some hesitation from the PBOC in terms of really cutting rates now.
That's right. We're expecting the loan prime rates to stay at just under 3.5% and 4% respectively for the 1-year and 5-year. And that's mainly because the PBOC had kept MLF rate unchanged on Monday. So commercial banks are not likely to cut rates when their borrowing costs from the central bank is not lowered. But there are strong arguments for PBOC to ease further given this low inflation and fragile recovery. So our expectation is that the PBOC could cut after the Fed goes first, just to lower pressure on the yuan. And because commercial banks tend to go in lockstep with the central bank, we could perhaps see the loan prime rates being cut maybe closer to the end of the year.
Now, the central bank also talked about how they're Yvonne mentioned this earlier on, how they're studying an option how to manage policy on the short end of the interest rate corridor. I mean, they've said it's not QE. How should the market be interpreting this?
Yes, so our Bloomberg economics take on this is that QE is on the horizon, but not in the form of bond buying, because we already see this bull run in the bond market and the PBOC repeatedly warning of a bond bubble. So the last thing they want, I think, at this point is to buy up even more bonds to push yields even lower. But what they could do is to participate in QE in a more limited and targeted way. They could do so by participating in that home buyback program. So far, they have injected 300 billion yuan to state banks to help buy back unsold homes. That's largely seen as very insufficient to mop up those huge amounts of excess inventory. So there are expectations that the PBOC could inject more liquidity into that. And if they do not withdraw liquidity from other channels to kind of offset that funding, then that's in a way a form of QE, because they're expanding their balance sheet there.
Min Lo, fantastic. Thank you so much, our China correspondent there. Let's get the take now from Redmond Wong, Chief China Strategist at Saxo. He joins us here on set. Good morning and nice to see you.
Yeah, good to see you again. Good to have me.
Are we headed into QE at some point in this market's future?
I think I agree with Bloomberg Intelligence observation. Is the QE, I mean, the tool is one additional tool now being available, but not really coming in any big time, big scale or any time soon. Exactly the lending facility, just your colleague talked about, and also the PSL, the pledged security lending. I mean, those are actually tools that the PBOC can actually already doing some injection of liquidity or printing money or kind of QE. I mean, they can do that, like 300 billion for that buying off of some housing inventory, a full policy bank, and then is going through other 21 commercial banks and that. But for QE, I think going back to the bond buying, okay, the announcement is, I think the key, the important thing is in the past, I mean, you have two policy tools. One is the 7-day OMO rate, the short end, and then the 1-year MLF. And the 1-year MLF, they have to serve two functions. One is actually is anchored to rate. Right? At the same time, you are using it to inject money, because since 2014, you can't really, there's not so much capital inflow, so you are not buying FX to inject money. So that's one rate serving quantity and price, and try to control balance the two. That is a bit tricky. So they want to add another tool so that actually they can use this kind of bond buying in the secondary market to control the quantity side. So actually lift out some of the burden from the MLF rate.
So, I mean, it's still such a taboo, right, calling it QE in some ways, and they've really rejected this idea of QE. Is it necessary? Do you think that how effective is this tool, do you think it's going to be in this toolkit? I
think it's not well urgent, just want to get it available, because I don't think it's very urgent. For example, you look at just recently, I mean, one of the reasons the M1, M2, all those long data a little bit weak is also because it's what now when the government look at the performance KPI for the banks, is they shift some of the emphasis on the amount of loan they extend. And actually, they also put a little bit more emphasis on the profitability of those banks. So that actually creates some incentive for the bank not to exaggerate the loan amount by the end of the month during the observation period. So they are not very keen to really to boost lending, regardless of where those loans going.
Does it go into multi-aspect question? Does it improve the transmission of monetary policy? That's number one. Because when you look at interest rates now, they're extremely low already. Swaps rates, repo rates are already quite low. And it doesn't seem additional decline in interest rates will encourage lending. To your point, they want banks to be profitable also as well. And I'm wondering whether the market's confusing this as simply the PBOC looking to just do something else to improve credit creation in the economy that is right now not really willing or does not have the appetite for more credit at this point in time.
I think the PBOC is not very keen to really boost the credit creation very fast at this point. I think they're still happy to agree financing 8.4% year-on-year kind of growth rate. Yeah. But I think they probably want to have the tool ready. And I think one thing they do, they also now emphasize more on the OMO 7-day rate. And that is actually, and also they probably will also narrow the corridor of the interest rate. Now, the interbank rate is if they pay the 0.35% on the excess reserve, and the ceiling is 2.65, that is the SLF rate, standing lending facility, those basically discount rate. So they probably want to narrow and monitor a little bit, reduce the volatility between interbank, but probably they will allow the longer end, the rates to be a little bit more market-oriented.
Does it have any impact on this bond market, the CGB rally, in any way? I mean, we didn't see much reaction yesterday, but could it have anything long-term?
I think the appetite for you can look at those ultra long-term bonds. They are actually quite in good demand. So I think the economy actually in demand, a lot of liquid, and I mean, China's CPI is still hovering around 0%. So 2 point something. In the ultra long-term bond, you are talking about real interest rates. So there's a lot of demand. So now, of course, you have the central bank also here, even though the amount I think they are going to do may not be very large, but probably I think still a lot of demand for the government bond market at the moment. Yeah.
And the risk to that demand is if inflation comes back, right? To your point. Mm-hmm. And when we look at the upcoming third plenum, will there be a reflationary event that's possible there that then wipes out if you're sitting on a ton of CGBs at the moment?
I think there's a quite divided opinion on that. I mean, on the one side, you have economists like Dai Wenyuan, and saying that, now actually it's the inflection point. The government, probably the top leadership, will actually boost consumption and lift inflation. And on the other hand, it's already, I think probably you talk about at the end of May, you have that, 23rd of May, I think you have that interesting consultative meeting with entrepreneur and free economists with General Secretary Xi. And on that one, you include an economist called Zhou Qiren. I mean, he's pretty much, the disciple of Ronald Coase. I mean, it's a property rights, free market. Is institutional economist, focusing on institutional reform. So, and he actually was the first one to speak among the free economists in that particular meeting, as a very rare meeting. So, see which side to play out. But I think for longer term, I think to address the issue in China, probably I will go for Professor Charles. More institutional reform. More market-oriented reform, more reform actually for the private sector. I think so. There's still quite divided opinion, but let's see what happens. But I think that will not be so much about monetary policy. It's not the agenda. It's really on longer-term development model. And for the whole economy in the next 5 to 10 years, it's not about monetary policy for the next 1 or 2 years.
More reforms, less so about stimulus.
It all depends actually whether it's more stimulus or actually more focusing on the institutional side.
So do you think it's going to be enough to reignite this rally in Chinese stocks again?
I think the confidence more actually on the institutional side, because you need to give the private sector entrepreneur. I mean, the entrepreneur are not sort of liquidity. And it's not someone called a balance sheet recession. It's not. I mean, they have liquidity. I mean, they have the money. You need to give the confidence and the stability in the policy so that they can come back and invest. Yeah.
So the outlook for the equity market is what?
I'm hopeful, and because it's some of those, I think I become a little bit more positive than that last time when I was here. And I think the export doing okay and pretty well, mainly through the Southeast Asia, I mean, other Asian country. I mean, for example, in May, there's over 7% increase in export. Actually, half actually is because of the export to the Southeast Asia. The rerouting, reconfiguration of trade, going through Vietnam or India or Thailand, Malaysia. And then do some reprocessing and then go to the US and Europe. I mean, that is good. And then it's manufacturing picking up a little bit, and also in China activities. And so let's see what happens. I mean, of course, it's still very important to see what happened in July in the important meeting. But at the moment, probably the market wait and see, and a little bit more on the positive side.
We talked about certainly the Chinese side of things. Obviously, the U.S. side of things, we're still debating whether this is going to be a Fed that's going to cut this year or not. I mean, it seems like they penciled in one. The market still thinks maybe two. I mean, do you think that we're likely to see, the market more aligned with the Fed?
I mean, I tend to think that, it's in fact, actually, I would argue that way. I think, the market at the beginning of the year is expecting 6.5, 7 rate cut. I mean, now they're down to about 2, and the Fed now is lowering 1. I will argue it's really that important to the equity market. I mean, as long as it delivers somewhere around that and then communicate. To me, actually, the bigger elephant in the room is really the deficit. If you look at the latest CPO forecast, actually came out on 18. Actually, just 2 days ago. And you are talking about by 2034, the primary fiscal deficit in the U.S. is still above 2.7%. And above 2.7%. It's rise up, actually.
Right. Okay, Redmond, thank you. Redmond Wong, their Chief China Strategist at Saxo, joining us here. Just two things that just crossed your Bloomberg here. So that LPR rate coming in, both in which unchanged. So you talk about the 1 year is holding at 3.45. That 5-year LPR also unchanged at 3.95. I guess no surprise, given we didn't see any change in the MLF this week as well. But yeah, an interesting fix today, though, Dave.
Yeah, the closest I believe we've been to 712 in many months here. So the midpoint of the day is 711.92 against the U.S. dollar. That should be the weakest fix or the highest fix. And as you can see, the currency is reacting to that as we speak mechanically, of course, also amid the FX pressures that have come through. So it is the weakest fix going back to November of last year. Yep. All that considered, the opening bell is, 13 minutes away. Stay tuned for that in Shanghai, in Shenzhen, and here in Hong Kong. You're watching The China Show. Okay, we're going into the session today with, I think the most pronounced here would be the weakness in the Chinese currency. And as you can see, we're now closing in on 729 on the offshore rate. So we'll see what the onshore rate opens up at. I would imagine that would have some sort of gap at about the open. The weakest fix, bottom of your screens here since November of last year. Tariffs, of course, still very much in focus. This equity market rallied hard yesterday. We might actually get a day two of that. We'll see. Opening bell about 10 minutes away, give or take.
Yeah, well, of course, we've been tracking what's been going on in the trade side of things. China is said to be preparing a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. And the likely targets include a whole list of certain products. Let's bring in our chief North Asia correspondent, Stephen Ingles. He's here right now. I mean, what are they looking at? What are they eyeing at here?
Well, first and foremost, I have to say China will never call these retaliatory tariffs, right?
Right.
Because they've already launched their own dumping investigations in brandy and also into pork.
Yeah.
That would affect Spain in the pork side, and it would affect France, of course, in brandy, and cognac is a type of brandy, obviously. So they're the biggest producer, and China is the second biggest market. But they've already launched anti-dumping investigations. So they're going to find ways that these potential tariffs that they're weighing against European producers of these various products is not retaliatory. It is anti-dumping investigations. That being said, the likely retaliatory nature of it would probably hurt Europe much more than China. China needs to import many of these products, but this time around, basically from hints from the government, as well as what state media is saying, that they'll target products, kind of the fun stuff from Europe. Agricultural, food and cognac and wine, pork, cars as well, and dairy products from Denmark and the like. So it's likely to happen. We're getting hints from state media. We're getting hints from the government. You're seeing the wine there. That could be one of them. Obviously, that would affect the Mediterranean countries like Italy, France, and Spain, the wine and grape-growing regions. This is the pork. Spain is the big one. China is the #2 export market for Spanish pork. As I said, there's already a dumping probe begun here. So again, we're looking brandy, wine, pork, cars. That's an interesting one, too. A very big sticking point in Germany. Their biggest export product are cars. Mercedes-Benz, Volkswagen, BMW, Porsche, you name it.
China's a big market, too.
China's a big market there. So we're hearing from CCTV, again, we're getting clues from state media. CCTV is reporting that Chinese automakers are pushing for the most severe, quote-unquote, tax action, upwards of 25% tariffs on large-engine European cars that would affect Germany disproportionately.
What's the other side? What are the potential product categories that might not come under new tariffs? You know, what products does China need?
Well, let's look at one of the biggest ticket items that come out of Europe. That's Airbus jets, right? But coincidentally or coincidingly, you're seeing already Chinese air carriers negotiating for about 100 wide-body jets from Europe. So they're not going to, well, they could still use this as an example, but would they want to raise tariffs at a time they're negotiating and trying to buy aircraft from Europe? Also, that would give a great advantage to Boeing. Keep in mind, they've already put a freeze on Boeing.
Yeah.
They're not importing Boeing jets right now. So this one, for now at least, is probably going to be put off to the side.
Stephen Engel there on the latest, our chief North Asia correspondent. A look at futures right now going into the open. Again, weakness coming through in the Chinese currency. More on this in a moment. You're watching The China Show. Welcome back. You're watching The China Show. In the early goings, we're looking at the spread between the offshore and onshore rate. And granted, of course, the onshore rate comes online in still a couple of minutes. So all that being said, with the head start that we were getting in the offshore market, the spread now is actually at the widest going back to early April. Bottom of your screens is the offshore rate. So watch what the open's going to be on the onshore rate following the weakest fix coming out of the PBOC going back to November of this year.
Yeah, so
November
certainly
last year, sorry.
That dollar strength certainly is still there. 7.28, right, as we talked about. Really, that was more interesting than really what we got from the LPRs, which was basically they kept those rates on hold. So certainly we're watching very closely how this equity market fares. Obviously, still looks like we're extending the gains that we saw yesterday after some of these kind of market reforms that we heard from the likes of the CSRC as well as the PBOC, talking about how they're changing their toolkit a little bit as well, how they're targeting some of these rates maybe in the short term as well. So certainly we're seeing extended here, HS Tech, but we're, decent, just modest upside there. But the tech stocks, these are the ones that did pretty well yesterday.
Very, very well. Yeah.
There you go.
On Tencent, we're a couple of bucks from the highs we hit early this year. We'll see if we get there at the open. This is Bloomberg.
Welcome back. You're watching The China Show. We're counting down the open of markets there. And, what you take a look at here, it's pretty slow going, so to speak, here. We're not getting the same sort of follow through given that U.S. markets were shut overnight as well. And really, we're still, though, seeing some decent gains here. If you take a look at what we saw yesterday, though, the best day for H shares in 3 months on some of these market boosting policies that we heard from Liu Jiazui. So that certainly is keeping at least some of that sentiment here today. But then, we're dealing with a weaker currency here this morning, Dave.
Yeah, so we're looking at what the open's going to be like. On the onshore rates, we were trading at 728 and change, closer to 729 on the offshore rate. A few seconds before you actually get that, a couple of things when you go into the open. So this divergence again between onshore and offshore equity markets in this case here. So the volumes on the CSI 300 actually fell to the lowest since January. Yesterday, we're looking at, again, in terms of price, stock in a very tight range with a bias towards the downside. A lot of that maybe have to do with the fact that you are getting some pressure still on the likes of these very heavily weighted stocks like Maotai. For example, yields continue to push lower on the Chinese 10-year yields. More on that, of course, in a moment. And, of course, the loan prime rates, no change there on both the 1 and the 5-year. More analysis coming up on the specific rate outlook. Now, let's look at our open in Hong Kong, please, if we can. So the best day in about 3 months. Volumes also picked up as well. We're looking at also this specific group of stocks. Where is my HS Fin index? I think it's this one, actually. So brokers, banks, insurers did very, very well yesterday. on the back of this sort of comeback in market participation. Tencent, we're looking at that closely. We're opening at 388, give or take. 397 is the high that we hit a couple of weeks back. We'll watch it very closely. There's news out of Tencent, so them actually pulling that very popular gaming title from some of the Android phones. I think there might be some discussions there around what those agreements actually look like. Yesterday, really big gains with like a SenseTime and Lenovo. In fact, Lenovo was up 10%. Lenovo is actually at a 9-year high at about these levels, at $12, right? So SenseTime actually saw a very big gain as well yesterday. We talked to banks and brokers, so we're not getting a day two there as well. And as promised, we're now looking at the onshore rates. We already hit the weakest of the year on the Yuan yesterday. So we're opening today. We'll see how that looks. 6-month chart. Yeah, there we go. And there we go. 725.86 is your rate at the moment. Yvonne.
Yeah, it's interesting that we see a weaker fix like this on a day that U.S. markets were actually shut. We probably didn't see a whole lot of, liquidity or volume when it comes to FX side of things. So it's pretty interesting that you're seeing this. Let's get more of this with our Chief Asia FX and Rate Strategist, Stephen Chu. What do you think is the message really being sent there? That, does the PBOC really just letting the currency weaken more now?
I think we have to look at how the yuan has been doing this year. Actually, it's one of the outperforming currency in Asia this year because they have kept fixed unchanged, given the dollar is still so strong. So now, actually, when market is somewhat calm, as you said, US is out, it's probably a good timing to let fixing slowly flow higher so can actually pull back that support a little bit, because later on, market is going to go back and see when the Fed is going to cut. It's going to be July, it's going to be September. And if the dollar drives higher, then it will be harder for them to let the fix move. So now, at a quiet time, it may be a good timing to do that.
Now, you just to change topics, you've written about this conversation around quantitative easing in China, but you're calling it QT. Why?
I mean, to be very honest, market has been talking about QE. It's really quotation QE. Because when we talk about central bank buying and selling, actually, of bonds, how do you call it QE, QT? It's when the buying and selling is large enough compared to the market itself or to the balance itself. But now it's actually very small. If you look at the PBOC balance sheet, it's only holding 5% of CGBs. It's not going to buy that much. It's not going to sell that much. So that's why it will never be the proper QE and QT. So I add quotation out there. And market only focus on the buying of the bonds. But if you look at the bond yields, they're at record lows. 10-year is near record low. And PBOC has warned about these low yields, the duration risk out there. So why would they want to jump in and buy when there are so many demand out there in the private sector? Now, in fact, what I think is that they may actually start selling first. So yields rebound, market got spooked, yields rebound to a more appropriate level, then they could buy from there. That makes more sense. And the Chinese media actually cited that China thinks that a fair value for the 10-year and the longer end yield, it's in the range of 2.5% and 3%. We are at 2.25 now. So I don't think it's actually attractive for PBOC to jump in and buy.
Well, what's the outlook for rates then?
For the earlier part of second half, I think rates will actually sell off or rebound a little bit higher, if you put it that way. And then buyers will come back again.
Does that mean that they need to, though, cut rates in order to justify this where yields are right now?
I think certainly, but people always look at the 1-year MOF now 2.5 and compare that to the 10-year bond yield where it's 2.25. So that's why from a MOF perspective, the 10-year yield is way too low. So unless they cut rates aggressively, which obviously they wouldn't do that before the Fed moves. So that's why they will have to support the bond yields before they start cutting rates.
So the holders then, particularly those who have built duration, and a lot of them recently, right? 10-year yields, 30-year yields. How big of a risk now are they facing if the PBOC starts selling?
It's quite a lot. I think the recent buy-ins are mainly from the non-bank financial institutions, because the banks are already the largest holder of over 60% of the market. Right. So obviously they perceive it as like a very safe asset, especially with all the policies in China, all the regulations. So they really have to lower the duration risk instead of keep buying the CGBs. Otherwise, when that hits, if you remember a few years back, people say will hit market when the easing expectation is too strong.
They have to be very gentle, though, because they're going to hit the banks quite a lot if the CGB market, I wouldn't say crashes, but if it falls significantly, a lot of the banks are going to take a significant hit.
Yes, so they will have to keep doing verbal warning for now until they do something actual.
Yeah. Okay. Massage the market mindset.
Yes.
Stephen, thank you so much. Stephen Chu, our Chief Asia FX and Rate Strategist at Bloomberg Intelligence. From FX and rates to equity markets now, and let's bring in our Asia Stocks reporter, Sang-Mi Cha, to talk us through the market story of the day. Anything we should watch out for as far as the market impact of these unchanged interest rates, LPR?
Right. So it was widely expected that it's going to be kept unchanged. The commercial banks they're struggling to actually lower and reduce these lending rates with without the more of that cost, funding costs coming from the PBOC, right? So it's widely expected, but then at the same time, the market has been waiting for game-changing measures, and this will be adding to more of the acceleration of this downturn that we've been seeing. And so more of these measures are needed. That's what's widely been talked about at the among the traders, and of course it's reflected in the data. We've seen the northbound net sold in the A shares. It's the longest this year. For the 8 straight days, we have been seeing that. So we'll have to watch how it's going to perform today.
Hong Kong stocks jumped, though. We saw on the back of what has been the sort of policies around capital markets and the like here. What else are you watching out for today on some of these policies?
That's right. We yesterday's forum, which is ongoing today, has been some of the good news and the packages. Interesting thing was how the Hong Kong is allowing or actually trying to help the mainland investors to invest in or buy the Hong Kong stocks with the yuan. And that would be a surprising move, and also, more of that dividend tax cut that they're considering from Beijing on the 20% dividend tax cut from the Hong Kong stocks is also interesting. We're watching Sasa earnings today. Consumption has been some of the main issues that in terms of sectoral themes that we have been looking at. There is this ongoing save rather than spend kind of mentality in China, so we will be watching that. And also Meituan and Tencent were the main gainers in the Hang Seng Index yesterday, so we'll be watching more of the tech stocks today.
Okay, Sang-mi, thank you so much on all the things to watch. I was actually at Sasa a few days ago.
What were you buying there?
I was looking to buy perfume.
Oh, okay.
Yeah, didn't end up pulling the trigger though. So. Not useful information at all.
No, not at all. All right, coming up, we're going to talk more about South China Sea. The light, the Philippines accusing China's Coast Guard of destroying its boats and looting firearms during a clash in the South China Sea this week. We have details next.
All right, welcome back. You're watching the China Show. So the latest here on these tensions in the South China Sea. The Philippines is now demanding China to pay for damages after this clash in that part of the world earlier this week. Now, Manila has accused the Coast Guard, the Chinese Coast Guard, of illegally boarding its boats during this resupply mission to a military outpost on a disputed reef. Let's bring in Cliff Benson, our Bloomberg reporter in Manila, for us for the latest. And yeah, Cliff, this is what are we hearing from Manila? What happened this time? What's their version of events?
Yeah, hi. According to the Philippine military, the Chinese Coast Guard obstructed again one of its routine resupply mission to the Second Thomas Shoal early this week. But this time, according to the Philippine military, the China Coast Guard personnel seized Philippine weapons, punctured inflatable boats, and Philippine Navy personnel lost a finger when the Chinese rammed one of the Philippine boats. According to the China Foreign Ministry, however, the actions that were taken by the China Coast Guard were part of law enforcement measures and that they were conducted professionally.
Can you tell us what else to watch out for next after this?
Yeah, we're watching the developments. Philippine and U.S. officials have discussed this latest incident. Washington has reaffirmed that its mutual defense treaty with Manila extends to any armed attacks on Philippine public vessels anywhere, including in the South China Sea. President Marcos has yet to publicly comment on this latest encounter, but he has previously said that a fatality may trigger the mutual defense treaty with the U.S.
Yeah, and we Cliff, we were browsing also Chinese media this morning. The Global Times also had a reaction there from the Chinese side and I think we're going to show that to our viewers as well. What has been the reaction from other countries to this latest confrontation?
Yeah, several countries have expressed grave concern over this latest incident, which I think one of the most serious encounters so far between Philippines and Chinese ships in the disputed waters. Japan, for instance, said that the ambassador of Japan to the Philippines said that Tokyo was standing with the Philippines and it will cooperate with like-minded nations to maintain an open and free international order. Australia has said, the Australian Foreign Ministry has said China's actions endangers peace and security in the region and creates a risk of miscalculation and escalation.
Cliff, thank you. Cliff Benson there joining us on the latest when it comes to South China Sea. Some other geopolitical stories that we're following today. U.S. intelligence sources say they believe China's leaders have no clear favorite between Joe Biden and Donald Trump and their likely presidential election rematch. The U.S. assessment is matched by interviews with Beijing officials who think both candidates are intent on containing China. While Trump has threatened higher tariffs, Biden is seen pushing regional alliances against China's rise. Chinese President Xi Jinping has called for greater loyalty and discipline in the country's military. Speaking in the city of Yan'an, a stronghold of the Communist Party, he also called for a tighter policing of graft. At least a dozen senior military officials were removed from their posts last year in a corruption crackdown. Lawmakers in Taiwan are beginning a new round of debate over a bill that critics say is aimed at reining in President Lai Ching-te. The measure would expand the power of lawmakers to investigate government projects and policies. The move brought protesters out on the streets again, similar to scenes that we saw last month. The demonstrations in May were some of the largest in Taiwan in decades. Former U.S. House Speaker Nancy Pelosi has accused China of trying to erase Tibetan culture. She was speaking after a delegation of U.S. lawmakers met with the Dalai Lama in the Indian town of Dharamshala, a visit that was condemned by Beijing. Pelosi says a recently passed bill strengthening U.S. support for Tibet sends a strong message to China.
Let's stay on this theme of geopolitics. So Vietnam has welcomed Russian President Vladimir Putin after he arrived in Hanoi on Thursday. That follows, of course, the Russian president's trip to North Korea. John Herskovitz, our East Asia government editor, joins us now to take us through some of the takeaways. Yeah, let's start with the summit between Putin and Kim. What were the key takeaways, the main takeaways, John, in your view?
Well, the two things that came out of this are, first, in the near term, that Kim Jong-un promised to unconditionally support Russia for its actions in Ukraine. This means that the flow of munitions, the artillery shells that North Korea has been sending to Russia are going to continue, and this will be difficult for Ukraine. It'll be difficult for the U.S. and its partners. The more that North Korea sends over, the more that the U.S. needs to help fill the coffers for Ukraine. And the scale has been enormous. South Korea's defense minister spoke with Bloomberg last week and said that the amount of artillery shells could have reached nearly 5 billion. This comes as the EU is struggling to fulfill its pledge of about 1 million shells. The longer-term takeaway is a mutual defense pact that North Korea and Russia signed. They pledged to come to each other's defense. We're getting some text of that coming in right now on North Korea's official media. This brings them back. This rekindles a Cold War document from 1961 about coming to each other's aid if they're attacked. The longer-term implications are difficult to work out at this point, but it makes it more problematic for the U.S. when it looks at contingencies in the region, knowing that there is the possibility of Russian intervention when it comes to something with North Korea. And on the opposite side, does this mean that North Korea is going to be aiding Russia in what it does in Ukraine?
And we did hear from the likes of the Secretary of State of the U.S., Antony Blinken, calling, the summit and Russia really in some ways in desperation to strengthen relations with countries that can continue or help them continue this war in Ukraine. I mean, where does this leave the U.S. now, John, and its partners in Asia and Europe?
It makes it much more difficult for the U.S. and its partners going forward. And North Korea offers something that almost no other country can offer Russia, a huge store of munitions that are interoperable with the systems that Russia has taken to the front lines in Ukraine. And we've talked about artillery shells. North Korea is looking at ballistic missiles. And it also has oddities like spare parts for tanks that the Soviet Union had in the 50s, 60s, and 70s. North Korea has large stocks of these. These are things that Russia could turn to, and Russia and North Korea share a border. They have ports on the Russian Far East that are very close to North Korea, and they can send. There have been cargo ships shuttling between the two. It's very difficult for the U.S. to stop the cooperation between these two.
Now, he's moved on to Vietnam, Vladimir Putin. What are we to expect there?
The official meetings are probably going to be starting in an hour or a few hours from now. And we're just going to see, again, the second phase of Russia's push into Asia, looking at a Soviet-era partner. And we're going to get we're looking at some energy cooperation. Putin said this is a part of his trip in an article he published before arrival in Vietnam. And also for Vietnam, which plays this balancing game between China, the U.S., and Russia, it helps increase the size of the Russian card it can play in this. If it's coming into difficulties with oil exploration in the South China Sea, it helps to have a friend like Putin around if need be.
John, thank you. John Herskovitz there, our East Asia government editor on, of course, Putin's trip. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show, so we're just getting warmed up here as Thursday gets underway. Bank of England, that's a reminder, really, that it is Thursday.
Yeah.
That's one to come up today. A couple of central bank decisions as well. No change expected on all four, I believe. I think Paraguay was also out, if not coming out quite soon. But there, some of the four that we're tracking here. Interesting is the Bank of England and how the voting goes, I guess, and also S&B, because the economists, when they look at that, it's almost evenly split on whether the central bank moves or not.
And I think with the Bank of England, it was just a couple weeks ago when it was almost like a done deal that they were going to cut at this meeting.
Yeah.
And really follow what the ECB did. But then came this election, which I think kind of threw everything out of the way and really kind of ruled out that rate cut when that election happened. So I think certainly that's going to be the key thing. Inflation data also did, bolstered the case to maybe wait a few more weeks to see whether, of course, we are heading that disinflation trend.
The last voting split was 7-2.
Okay.
I think the economists are expecting also 7-2, although there could be one more vote in favor of a cut, which would give us an indication of how live the next one probably will be.
Yeah.
6-3, I believe, is tail risk as far as the voting goes. We're really getting to the rabbit hole of these things here. Bank Indonesia expected to hold on the back of the last move, which was a hike. Yeah. That's a currency story.
I mean, there's certainly concerns around the fiscal side of things. That's what's leading to the drop in the rupiah. The stronger dollar story certainly is not helping either. So maybe there is reason for them to stay on this sort of hawkish sort of hold here this time around. So certainly there's the currency that's the big concern for Bank Indonesia this time around. In terms of other stories that we're watching out for here today, and a check of markets, obviously the bond future side of things for China continues.
Again.
There you go. So we're talking about, I think it's a sixth straight day that we've seen gains on bond futures there. So really, they're just kind of, this whole prospect of QE, not really doing much for a lot of bond traders here. They're saying, look, maybe it's going to be a gradual process. Maybe, but then, it was interesting that Stephen Chu mentioned, there's also this aspect of they could sell CGBs too, that you might need to worry about.
They could shrink or expand the balance sheet, right? And you made a very good point that if they're pushing back against the notion that bonds are too expensive, why would they go against that and keep buying and depress rates even further? Well, the markets are doing the buying for them, is pointing out, and that's exactly what we're seeing in the bond markets today. Have a look at where we are as far as the broader market complex is concerned here. So Asia and, well, the China dashboard for you. Hang Seng Index is now back above water. A couple of minutes ago, we dipped back below zero. It looks like we are now pushing session lows on the CSI 300. So at about these levels, let me just give you a quick check where we are. We should be at about 6-week lows on this, if not more. Yeah, we're now trading at the lowest here since April 24 of the year. Tech is seeing some profit taking after the big pop that we got yesterday. And, of course, other metrics, we're seeing still a pickup in volatility. And, of course, the currency coming through in the Chinese currency. Offshore rate on your screen, 728.50 at about the midpoint of your session here.
Yeah, there's a lot of commentary right now about why we did see this weaker fix from the PBOC. Are they really kind of tolerating a weaker currency now? But the timing of it is interesting. When U.S. markets were shut on Wednesday, maybe it's a time when things are slow to maybe allow it weaken just a little bit right now. Coming up in the next hour, JPMorgan Asset Management will be with us to chat about their latest fund, what they're doing with Asian investors and the like, plus our exclusive interview with Fourth Paradigm for the outlook of China's AI development. Welcome back to the China Show. Here's a look at the HSI just a half hour into the session, and it's just been kind of slow going all morning here. We're just about 0.25% lower here, so we're near those session lows. And also, this is after we had a pretty stellar day yesterday in the back of all these, news about market boosting policies when it comes to what the CSRC mentioned as well. So certainly we're seeing a bit of a pullback here, which is not sort of surprising given the rest of the region is sort of doing the same here this morning. Dave, it gives us time to talk about other things.
Yeah, the big picture stuff.
Yeah.
What are your plans on the weekend? Oh, not that kind of thing. Not that kind of thing. Well, why don't we talk about the currency? I think to your point, right? So the fixing was interesting today, not just because it was on the weaker end of things. It's because we didn't have a lead coming out of Wall Street overnight, right? So maybe the opportunity to allow for more adjustment while not a lot of people are looking.
Yeah.
Yeah. And hence where we are, 728.44 against the US on the offshore rates. No change, of course, on the loan prime rates. That's the other thing, too. And then there's profit taking, obviously, from the rally we had yesterday.
And it seems like from some of the commentary I'm hearing from why they decide to do it now, maybe the timing, as you say, with U.S. markets closed, but also maybe there's a chance for them to really narrow that gap between the spot and the fix. Right now. It's not really about whether they're letting the currency go at some point. So it's a little bit of just like fine-tuning, maybe.
That's a good point, because I had a look at the basket earlier on, because they've kept the fix at about this level. The Yuan's actually, the basket, it's up against the basket of peers, actually. So that's important context here for us as well. Okay, let's have a look at other things here. So other markets trading across the region. So obviously we're looking at a fairly important as far as monetary policy is concerned, not just the PBOC, the Bank of England, you have the S&B, you have Bank Indonesia, Norges Bank as well, also out. All hold. As we were talking about earlier, the Bank of England is more a guidance story and a story of what the split's going to look like. The split on the S&B is quite almost evenly split, so that's going to be too close to call in some ways there. Hedging costs on the Swissy, I believe, are now also inching higher as well. I guess that's a reflection of that. Other things too, so 2 and 10-year yields, U.S. are slightly to the upside. And I believe we also have this, we're talking tacos.
Oh, yeah, why not?
Tacos.
I'm hungry.
Avos. Hot sauce.
Yeah, Guzman y Gomez. Okay, so this is a very interesting company that's just listed on the AXX. So it just came on, mind you, maybe 2 hours after markets open. But certainly the story behind it is interesting, right? This is at a Mexican food chain that's in Australia. I believe they're also in parts of Singapore, Japan as well. But it was basically an American, Stephen Marks, that moved to Australia in the early 2000s and was like, Mexican food is no good here. I'm going to start my own. And look where we are now, $135 multi-million-dollar fortune now.
Former hedge fund trader.
Yeah.
There we go. There's life after the fun. There's life during the fun still, right? Okay, that's the story there, 37% to the upside. To more interesting news, though, the loan prime rates. Let's talk about that. Changshu is here on set to talk us through this. No change. It's not exciting to talk about Chinese interest rates.
Yeah, not particularly exciting. I mean, it's not a surprise given the PBOC extended the hold on Monday, right, on the policy. I guess the more interesting question is why the PBOC is holding back. The market has been having quite intensive discussions whether it's because of the narrowed interest margins amongst the banks or it's the currency stability. We have always thought the latter is more important. I entirely agree with Yvonne. The PBOC is not letting the currency go. And this was made very clear yesterday by the Governor Pan Gongsen's remark at Lujiazui yesterday. So this is not great because it means that the PBOC is tying its monetary policy with that of the Fed, essentially. Our U.S. team is anticipating 2 cuts for the rest of the year, September and December. So that potentially leaves the PBOC 2 moves, perhaps to a total of 20 basis points cut. It's not helpful. We know the economy does need support. Fiscal is doing something. Property markets, new measures coming out, but still monetary policy support is needed.
Still, we're hearing maybe a shift in maybe how they use the toolbox. And I think the fact that they brought up this prospect of QE, I know they're not calling it that, but what do you think? How significant is this news?
It's a yes and no. So we think the PBOC is doing some sort of QE, but not through trading of treasuries. The treasuries, the PBOC is more like adding it to a liquidity management tool, and the central bank categorically said no QE. But we actually see some sort of QE happening because the government, the PBOC, is using a relending scheme to support house purchases by the government. So we think this could be similar to what they did back in 2015 and 2016 to support shantytown renovations. They provide the funding without offsetting operations. That's essentially a QE, kind of targeted, limited one, but sort of QE in a different way.
It's a different asset that they're purchasing.
Yes,
and not a financial instrument, but where the money's actually needed.
Yeah.
So my question now is, it's a move towards making policy transmission perhaps more efficient. What do you make of the current policy toolkit right now and the need for them to look at the shorter end of the curve to conduct monetary policy?
Yeah. Essentially, it's not so much the monetary policy transmission itself. And I mean, the monetary stance hasn't really moved. The PBOC is doing some things, kind of targeted support, etc., encouraging the banks to lend to the private sector, and also the government, the PBOC came out to urge the banks to roll out the housing purchase programs quickly. So it's more the limited monetary policy stance moves rather than the transmission itself at this point. That's challenging.
Okay, Changshu there, our chief Asia economist at Bloomberg Economics here. Just a brief look at markets right now. So we should be slightly lower for the day. We've been watching a lot of things, right? So day 2 of the rally here in Hong Kong, which is petering out. We're down 1%. Benchmark's down 1%. Even TSMC is also seeing some pressure after that massive move that we got yesterday. Let's talk markets now and bring in Julie Ho, Asia ex-Japan Equities Portfolio Manager at JPMorgan Asset Management. Good morning.
Good morning.
It's the Asia Equity High Income Fund. sounds like a new strategy. Is it a new strategy?
It's fondly known in the Hong Kong market as Ahi High.
Ahi High.
Yes,
I like it.
Bit of tuna in there, yeah?
Yeah, a little bit of a kicker there. So this is a strategy we launched end of last year.
Okay.
So it's been 5 months. And really the question is, why did we launch a strategy? And it really dials back to what is the defining feature of an Asian client? They love income. Why do they love income? It stems from a desire for knowing the certainty. What am I going to get? But also a fear of volatility. So when we look at short-term, medium-term, long-term performance, equities has handily beat fixed income. It's beat bond markets, beaten the money markets fund. Why are investors still parked on the sidelines? And so this is a fund that was really created to address exactly this issue, to give clients a reason to come into Asian equities and, importantly, to stay there.
It's interesting because you mentioned that 60% of your assets are held in money markets or in fixed income. Why do you think there is that dry powder still in the sidelines? And how much are we talking about, really, in terms of Asian investors? What's so hesitant? Why are the hesitancy?
Yeah.
So this is 60% of Asian assets are held on the sidelines or fixed income, and the hesitancy is they don't like to see the markets fall, even though when they see over medium term, actually markets tend to go up, and they don't like that they're going into something not knowing what they're going to get, and so that's why with this fund we're signaling to them over a cycle you should be getting 7 to 9% total return in Asian equities. We're signaling to them there's a way to be involved in Asian equities with lower volatility. So what we're really trying to generate in this fund is 3 things. The first thing is we're generating you higher income, 7 to 9% over time, and that's an earned income. It's from the underlying equity portfolio's dividend, as well as some option premium. Okay. The second thing we're delivering to you is you are getting that substantial exposure to Asian equities. Yes, we're doing some option overlay, but that's only 30%, which means 70% of your portfolio is completely unencumbered to the upside. And don't forget, we're active managers, so you're still keeping 100% of your alpha generation because we're using index call options. And the third is just a better experience. Sit tight with us because we'll give you lower volatility, lower beta
You're
experience.
selling it, Julie. You're selling it.
It could be boring, though, because, well, I'm looking at some of your top holdings, right? We're not going to name names, but certainly there is exposure to the upside. But it's like having your cake and eating it too, right? We were talking about tacos. It's like tacos without hot sauce. It's like fried chicken, but you don't want to have the crispy skin. So you're selling the upside, but how much less volatility am I in for right now?
Why don't we talk about the performance? So we launched just at the end of last year. So as of end of May, it's been 5 months. What have we delivered? We've generated 8.3% income. So that's an annualized, right? It's an annualized income number, 8.3, and that's actually what we've generated. We've delivered you a total return of 5%. So yes, the market over this period is up a bit more. It's up 7%, but we're still giving you 5%. And your volatility experience has been 20% less in the market. So that's certainly better than just sitting on the sidelines or sitting on your hands.
Okay, so where are you looking at in this equity market now? I mean, the themes it looks like it's Taiwan tech. What else are you looking at beyond that?
Well, tech, it's Taiwan, it's Korea. We could certainly talk about that. But I think one thing that's really evident in Asia is improvement in shareholder returns that we're seeing across Asia, well, most evidently in Korea and China. So there are opportunities there. And thirdly, what about the plain tackle? What about just the plain defensives that have lagged the market this year because people don't want just the defensive names? So I'm talking about the opportunity to own the best Australian telco, the best Australian toll roads, or even some of the best malls. You're getting paid 5 to 6.5% dividend yield and an earnings growth. So it's really a variety of what's working and picking up what's not been working and seeing that there's a place in the portfolio for that as well.
Right. And, certainly you do give up some upside because of that, the boringness that you're injecting, for the lack of a more diplomatic way of saying it. That's really it.
We're a low beta fund.
Yeah, there we go. So when you look at the portfolio construction right now, what is the key risk? Is it a macro risk? Is it inflation? Is it rates? Is it something else? How do you deal with the risk component of this?
And this is the thing about being in Asia, right? In the last 10 years in Asia, it's all about climbing that wall of worry. And if I had to distill what is the biggest risk, it's a disconnection between valuations and fundamentals. fundamentals. And I think currently the setup is supportive for Asia. Valuations average 1.7 times book, average versus our history, but at a 2-decade low versus our DM counterparts. Fundamentals are improving. They're supportive because a better DM also supports better exports. So we're seeing improvement of exports in tech and also some non-tech areas. So I think as long as we're not overpaying for a fundamentally better picture, then that's fine.
It seems like most of your exposure is in the North Asia side of things. You mentioned a little bit about Australian telcos alike. China, is that in any part of this fund in any way?
Definitely. So China is 25% of our benchmark, so it still is a substantial portion of, we're neutral China now. And I think in China, it's really, I think there's a sense like, when are we going to get that beta rally? But as active stock pickers, having a weak economy and still having good stock opportunities, they're two completely separate issues. So where we find opportunities are 3 areas. And these are areas, by the way, that have been doing well, even in the down market last year, even before the April rally. So 3 areas. When you have an economy, when the sovereign yield is not much over 2%, you like these names that give you a baseline 4 to 5% dividend yield, plus an earnings growth that is visible. Yeah. So that's number 1. And don't forget, China is still a dominant exporter. So names that are good at what they do domestically and have that export channel are continuing to be opportunities. And thirdly, consumer. We're not buying, just thinking that prices are going to go up. But you and I know as consumers, we still have desires. We still want to have a feel-good factor. Yeah. So companies that could deliver that. And I'll give you an example. We talked about kids just now, right? Okay. What about if you can buy an air condition that actually could regulate its own temperature according to your kid's temperature when he's sleeping at night?
Please.
That's a tangible benefit you're benefiting. So if you find companies like that, they're fine. We're not saying broad consumers doing well, but there are always opportunities.
So you talk about interesting because there are many good examples out there of good companies but bad stocks, right? Some people use that phrase to describe NVIDIA, for example, just to name names, right? Good company, but the stock might be a little bit overpriced. Who knows? Where do you think valuations are right now on these AI plays in the region? Because you have some of these big names in your fund. Do you think we're divorced from reality, or is there more to go here?
We look at it very closely, and biggest names, we look at our biggest names, and they're mostly all trading below 20 times PE. So it's something where we think the valuations are still reasonable, but more importantly, are these names that could sustain their profitability? Are they in the right part of the AI chain? And how long will this go? We think that the CapEx cycle is just at the beginning. I mean, our own estimates is in year 25, we'll see the big hyperscalers, so the Amazon, the Metas of the world, spend 200 billion CapEx. And in 2 years from then, another 300 billion. So we think we're at the beginning of this. As long as valuations are still reasonable, we still have some time to go.
Julie, it's great to have you back. Let's not wait till another year. Julie Ho, Asia ex-Japan Equities Portfolio Manager at JPMorgan Asset Management. Later on this hour, we'll be speaking exclusively with Dai Wenyuan, the founder and CEO of AI services firm Fourth Paradigm. We're going to discuss the outlook for the company as well as the impact of tensions between China and the U.S. They are actually on the list of that U.S. entity list as well. So you're watching the China Show. This is Bloomberg.
All right, look at markets right now. We're about 45 minutes into the cash market session. And you know what? The Hang Seng right now is really definitive of the non-event that markets have been today. So far, still some downside onshore, and the Kospi index is also flat on your screens. About 10 minutes left in the morning session over in Tokyo. So relatively quiet day is the short version.
Yeah, it makes us, it gives a bit more time for us to unpack some of the things that we've been looking at and some of the themes that we've been tracking, whether it's tariffs, whether it's this kind of tensions between the EU and China. Obviously, since the EU talked about these tariffs on Chinese EVs, certainly we've seen a lot of action from China, at least in what they could be considering here, right? Retaliatory actions against the EU for those EV tariffs. And the likely targets include a lot of things, right? We talked about the fun stuff, alcohol, cars, food products. Here to break it down for us is Steve, our Chief North Asia correspondent, Stephen Ingles.
Fun stuff.
Fun stuff.
Yeah, not alcohol and cars at the same time, but
no. In separate measures. But why do you think that they're targeting these segments in particular?
because it will hurt Europe more than it will hurt China in these particular areas. Because, say, for example, in wine, that is one. We can bring up the list of the various things that we're getting clues and hints from state media on where China can hit Europe the hardest, in particular in reaction to these tariffs of upwards of 48% that have been proposed on EVs from China into the EU. So brandy, which includes cognac from France, as they say, all cognac is a brandy, not all brandy is a cognac, right? And then wine, the Mediterranean nations there, France and Italy and Spain, the like. But in particular, in wine, there's a particular global glut of wine right now. So if they're not going to be importing more, China's not going to be importing more because of any tariffs from France, they can get it from elsewhere, including Australia, because now there's some repairing of relations. Now, I think some of these targeted sanctions that we could see in specific sectors kind of imitates what China did when they had that trade disputes with Australia. They targeted wine, they targeted agricultural products. So we're talking also pork, which affects quite predominantly Spain. Also dairy, that impacts a country like Denmark. And you mentioned cars, that impacts a large automobile exporting nation like Germany. Already state media, CCTV yesterday, out with a story essentially that Chinese car makers are calling for the most severe measures against European automakers, whether it's the Germans or the Italians or even the French, basically asking the Chinese government to put 25% tariffs on large engine cars that are exported to China.
So this possibly are some of the categories that might come under pressure. What about the stuff that might not be addressed, for example? What does China need that it might not be willing to tariff?
That's exactly what I was going to say. What are the products that China needs that are not likely to tariff those products? And the big ticket item are airplanes from the likes of Airbus. We're also learning from sources that the Chinese airlines are in negotiations right now with Airbus on an order of upwards of 100 wide-body A330 Neos. So that's something Airbus needs to sell those aircraft because the A330 next generation of that aircraft hasn't sold as well as the A350. They want to get it going, the next generation A330 Neo, and China needs these wide-body aircrafts because they're not importing from Boeing right now, and it's a duopoly right now. So that is, I would say, even though there have been hints in state media and there have been hints from government officials in China that Airbus would be a good one, or aircrafts from the EU, which is Airbus, would be a good target, but it doesn't make a lot of sense.
Steve, fantastic. Stephen Engel, our Chief North Asia correspondent. Steve was just mentioning there, right? So some of the opening up that we've seen with other trading partners like Australia, and we did get an update today specifically on the wine element that we just touched on there.
Yeah, we all know Penfolds, right?
Yeah, why not? What's not
wines.
to like?
So basically they lifted those tariffs a few months ago, and certainly they're talking about really how seamless it has been putting, going back to business in China and the like here, and really the long-term growth opportunities. And basically, they're pretty much almost going all in to the mainland now.
It's a very big market. It was, and they think it will be, of course, for them. And to your point, right? So they started shipping based on the update from Penfolds China a few hours ago. We're taking this from that statement and that presentation, in fact. And what they said was it was seamless, right? So they started shifting back in March. It went through
customs. Like you said, like a fine wine.
It went down like a fine, complex wine, or maybe full-bodied one, of course, one of the Penfold specials. And I think let's get the statement up, please, for our viewers can see. Seamless and efficient customs clearance processes have been observed as product, in many ways, has arrived in market.
All right.
Yeah, a bit of a mic drop there.
Free flow.
Yeah.
All right, not free, but certainly flowing.
Mm.
All right. But yes, it's just another example that, once things do lift, or at least tensions fade, certainly we are seeing business still very much interested in doing business in China once again. Plenty more ahead. This is Bloomberg. Some big corporate stories that we're following today. Thousands of car dealerships in the U.S. ground to a halt during the Juneteenth holiday after major software provider CDK Global shut its systems following a cyber attack. Many car dealerships depend on the firm's systems to conduct their business. CDK says its dealer management system and digital retailing solutions have since been restored. EU automakers are readying new EVs across the price spectrum as the bloc prepares tariffs to protect its auto industry. Citroën plans to sell its second electric model for less than 28,000 euros to compete with cheaper models from Chinese brands. Meanwhile, Ferrari's first EV will reportedly cost at least 500,000 euros. According to Reuters, that price does not include options and compares with about 350,000 euros for an average petrol-powered Ferrari.
Wow.
Yeah.
Would you get yourself one of those?
If I had €500,000, nah, probably not.
No? No. We can splurge on some fine wine. Or just wine.
Yeah.
Yeah. We've been talking about wine and tacos all morning. I think I know what I'm going to get for lunch.
We're thirsty
tacos.
and hungry.
Yeah. Speaking of health, healthcare stocks in focus. Drug makers on the back of guidance here. Rallying. Sino-PetBio leading the charge here after this first half forecast that, obviously, as you can see here, impressed the markets a lot. Very quickly, venture capital-backed stocks, or venture stocks in general, on the back of more policy support expectations. This is Bloomberg.
All right, 11:29 a.m. in Tokyo here. Japanese markets are heading to that lunch break here right now. We're still seeing some downside when it comes to equities here this morning. So the Nikkei is down just about 0.6%. Not much movement on dollar yen, but yes, that dollar strength coming through. We're at a 158 handle for yen now.
Yeah. At about these, okay, so it's really this dollar strength story coming through again, right? And a reminder of that was really the fixing earlier on, which had to adjust to it. So I think our chief economist for Bloomberg Economics rightly pointing out that it's not really the PBOC looking to weaken this, but certainly adjusting to the reality on the exchange rate regime. Now, we're just going into the session, of course, on Thursday. A lot of central bank decisions on deck. Bank of England, SNB, Norges Bank, Bank Indonesia, to name a few. And we're also looking at the reopening U.S. markets later today. A 1/10% to the upside in S&P futures. In terms of sector breakdown, with the exception of two, energy and property, we're looking at downside across most of these markets. 0.3% overall in price. As far as bonds are concerned, we're still focused on really what we're seeing in the Chinese bond space, for example, right? So 2-year bonds are seeing some pressure, although 10-year contract is still up and up for a 6th straight day. So demand for this and demand for income continues to pile in here. Very quickly, we're also looking at other parts of this market. So just keep in mind, Lenovo was up 10% yesterday. SenseTime up 6%. Not quite what we saw. TSMC is pulling back as well. And just a look at TSMC ADRs, which traded 2 days ago, I believe. So on that specific benchmark, so there's a story out on the Bloomberg, if you're tracking this. So TSMC, the valuation surpassed Berkshire early this week. So I think 900 and something billion is now. So we're closing in on that 1 trillion mark on the ADRs. But effectively, we're just trying to say the street has been bullish. They've upped their forecast on the company's share price. And that's really making it effectively a $1 trillion company.
I think we talked about Morgan Stanley Citi, those calls just yesterday, a few days ago. Goldman Sachs was among the three also now that have lifted their targets for TSMC this week. But basically, I mean, for the likes of JPMorgan, they're thinking AI could contribute about 35% of total sales by 2028. So maybe there is still more to go. A bit of a pause today. Yeah. But yeah, I don't think it changes the long-term story. Let's stick with AI. As the tech tussle between China and U.S. intensifies, we're going to speak to Chinese AI unicorn that has been caught up in those tensions. And we're talking about Fourth Paradigm. They're Beijing-based. They're an enterprise AI services provider that was founded back in 2014, and they are backed by the likes of Sequoia Capital and Goldman Sachs. It's also been included in a list of firms facing U.S. export restrictions. Joining us exclusively now in Hong Kong is Dai Wenyuan, founder and CEO at Fourth Paradigm. Wenyuan, it's great to have you here in the studio. Thank you so much for joining us. You just launched your new platform here, the Four Paradigm Sage, a 5.0 version, might add there. But can you tell us a bit more? I mean, it's been about 2 or 3 months so far. What's the reception like in terms of your corporate clients and users now?
Yeah, actually, you have just mentioned the Sage AIOS. It's not a model. We all talk about the large language model. Sage AIOS is not a model. It's a platform to develop different kind of models in different industries, because China and the U.S. are different. In U.S. We have a lot of language data, so in U.S. we can develop a very good large language model. But in China we have a lot of industry data. Let me give you an example. One of our clients, top Chinese hospital, they have 1 million volunteers. Give them data in the last 20 years. So they collect a lot of data from their patient. Based on the vertical data, we can develop very good vertical industry models. So why we develop the Sage AIOS? Because we see a lot of large data corpus, the vertical large data corpus in China. So in China, our opportunity is to utilize the large data corpus in vertical industry to build up the world's best vertical models.
And how many clients do you guys have at the moment?
Actually, we have more than 130 large clients. We call it lighthouse users.
Okay.
The lighthouse users are Fortune 500 and listed companies.
And it's interesting because you highlighted what the company does. You provide solutions to businesses and the like. But then again, you're on this U.S. entity list. Can you tell us what you've done since then? And is there anything that you can do moving forward?
Actually, as a listed company, we have a very strict internal policy to make us to obey all the rules, all the laws in different countries. So I think we just working. We are just working hard to make people living better, make the companies work better. I don't know what we have done affect the entity list, but I think we are a listed company to obey all the rules.
Right. Has being put on the list affected the way you do business in any material way?
Our main customers are the commercial customers, just like the banks.
Right.
The biggest 20 banks in China are our clients, and for example, the retail companies, just like KFC, Starbucks, and Burger King. We don't have. We don't have so many government customers, so we are just working very hard to let people have cheaper chicken wings and make people can have better conditions in hospitals, and make the people can have cheaper and continuous supply of electricity. Well, I think all we want to do is to working very hard to improve our customers' business, so that they can improve. They can give better service to the customers. Actually, our slogan is AI for everyone. We just want to do better AI to make the people living better.
We always joke, AI, right? Love AI. For example, you mentioned that so most of your customers are in the private sector, private clients, for example, and you mentioned maybe some might be government-linked, I'm not sure. Do you think the political reality of being put on an entity list, for example, has made, maybe not specifically your company, but has made players in your industry rethink doing business? with government-linked companies because you run the risk of maybe unfairly being put on lists like this, for example?
Yeah, actually, for me for Paradigm, I think we are not get so many affected because we are mainly a software company. You know, in before there's several great software companies just like Oracle, SAP, Salesforce, and Palantir, and the software company. Their goal is to apply the latest, advanced technology to their customers. And for us, our mission is that when AI comes, we should apply AI technology to let our customers' business become better.
Obviously, it goes to show, though, that there are still a lot of obstacles geopolitically. I mean, you're not the only AI player out there that is facing these trade tensions, or at least geopolitical tensions with the U.S., chip curbs, the like. In some ways, how do you see the AI development in China evolving then, given that there is this no access to high advanced chips from the U.S.? Can China really domestically catch up, or do you think that gap is just going to widen with the U.S.?
Yeah, I think basically it's not a competition. It's not we want to develop a large language model and we see China and the U.S. who can be better, because China and the U.S. are different. In U.S., I think I just said there's a lot of English language data. So based on the large English language data, we can develop better language model. But in China, we have maybe in a lot of different industries, just like manufacturing and hospital and bank. We have the largest bank. We can develop the best vertical models, vertical large language, large industry model. That's why our main business is to provide the platform to help different industry to develop different vertical models. That's what China want to do, and you may see that China provide a slogan called AI Plus. That's AI plus different scenario, AI plus different industry. That's what China want to do. And if you working in China, you should make use the China's benefit to do the best work.
Yeah.
So I have a lot of questions, but I'm just looking at your financials. The analysts expect that your company has revenues or tops revenues of 5 billion renminbi this year, full year. Do you think you'll top 5 billion?
Yeah, I think we want to do the best to meet or overcome their forecast.
Okay. Are you confident you will?
Yeah, I'm very confident.
Okay.
Okay.
All right.
Wenyuan, thank you so much. Dai Wenyuan there, founder and CEO at Fourth Paradigm. We got plenty more ahead. This is Bloomberg. Here's your China Brief this morning. A look at what's making headlines in national newspapers, and topping today's coverage in state media is Xi Jinping's call for greater loyalty and discipline in the military. News outlets say that Xi delivered a strong message against corruption as he spoke at a military political work conference in the city of Yan'an. Now, Xi used a similar meeting in 2014 to assert his authority over the PLA. At least a dozen senior military officials were removed from their posts in a corruption crackdown last year. Meanwhile, the Global Times has published a story blasting a U.S. delegation's meeting with the Dalai Lama in India. The article quotes analysts who argue that Washington is trying to contain China using Tibet, referred to by its Chinese name Xinjiang. Now, it also warns that a U.S. bill boosting support for Tibet will damage relations with Beijing.
Yeah, and there's more really reporting from the ongoing conference in Shanghai, the Lujiazui Forum, in the financial press here. So the PBOC-backed financial news is actually expounding That's a good verb. Expounding on Governor Pan Gongxiang's speech. It cites unnamed industry players who say the central bank will make it clear that a short-term interest rate will become the main policy benchmark, something the market's been talking about all week, of course. That would reduce the importance then of the one-year MLF that, of course, every now and then we break here on shows and talk about a lot. Now, the China Securities Journal, just to pivot here to the overseas and the listing market here, is reporting that the CSRC Vice Chair Fang Xinghai's call to speed up the filing of Chinese companies' overseas listings. It says 158 firms have filed for overseas listings. That's as of Tuesday, and 85 in Hong Kong, 73 in the U.S., which takes us directly into one of the scoops out of Bloomberg this morning, talking about how some of these smaller companies that had been looking to list and raise money in the U.S. have encountered some friction.
Yeah, I think China kind of loosened the grip on that maybe a year or two ago, just basically just given how, it was hard to find funding in the domestic market, so maybe you still could list in the U.S. But now you're hearing the likes of the NASDAQ, according to our sources, is really increasing the scrutiny around some of these small IPOs. In particular, they're asking all these applicants whether their identity, their independence of the firm's pre-IPO investors selling shares in these listings as well. So obviously, there's also been a lot of scrutiny around some of these ones that are already listed in the U.S. AMTD Digital, for example, Dendax. I remember we were checking those stocks before. That surged like 32,000% when they debuted. Just a few years ago, only to crash basically weeks later. So certainly there's been a lot of questioning around New York.
It's been harder to get it listed. We understand also from our reporting that no IPOs have actually been pulled. It's simply that they've had to spend a longer amount of time, additional few weeks to get the process greased. Okay, speaking of grease and IPO, I'm not sure that's a pivot. Sorry. You don't want to get in my head. There's this big one, of course. Yeah. Down under.
We talked about this debut. Yeah. A Mexican restaurant, mind you, that was started by an American expat, surging in its debut in Australia here today. Let's bring in our equity capital markets reporter, Felipe Pacheco, joining us now. Yeah, why? It's interesting, right? We're talking about a Mexican company in Australia that's listed there. Why is it significant to the Australian market?
It's quite interesting, Yvonne. Like this deal all the way through when we started covering it a few weeks ago, we've seen a lot of interest by readers, not just in Australia, but across the region. Well, we haven't seen an IPO of this size. We're talking about $223 million US. It's not a lot of money, but still it's the largest in Australia in 1 year. And then, of course, if you look at the Australian market, you're usually seeing commodities companies, maybe a few that are financial, some funds, but you don't have like this type of offer, let's say. And then, of course, it's a company that's quite unique. You mentioned the founders. We have a New York hedge fund founder, someone who moved to Australia in the early 2000s. He gave us a quite interesting interview. We have a nice story out there today saying that he was not happy with the quality of the Mexican food that he found in Australia when he arrived there. And then he founded the first shop in 2006. Now they have around 185 across the country. And they said that they're going to use the money, the portion of the money that will go to the company will be used to expand in Australia mostly.
And I hear from some of our team that are based in Australia, these are very, very good. What's the company planning to do with the money?
Well, David, I heard mixed views on the quality of the food. I'm super curious to try because here in Hong Kong we don't have a shop. But for example, Singapore is their biggest market outside of Australia. They have around 17 shops. They just opened a new one before the IPO. They're planning to expand mostly in Australia, but their plans abroad are quite ambitious as well. They have shops in Japan. One of our colleagues in Tokyo went to check it out, and also in the U.S. What we know for sure is that they want to use this money to grow about 30 to 40 units, restaurants per year over the next 10 years. They want to get to the mark of 1,000 restaurants in Australia over the next decade. And it's quite interesting to see that analysts that were actually looking at the IPO from a valuation perspective, from a very, let's say, skeptical point of view. We're not talking about the food, but the stock itself. They are quite skeptical that the company company will be able to deliver a growth plan as ambitious as we know as of now. A lot of these analysts were saying that the stock was either fairly valued or looking too expensive. And this pop today is quite interesting because it will be curious to see if they'll be able to maintain such a high level for the stock price.
And whether they can actually scale up, as you say. I mean, you mentioned about 1,000 restaurants in Australia. That's the same number as McDonald's, right? Is that a competitor? I mean, what is the competitive landscape?
That's a fair point. It's very ambitious. The owner told us in an interview that they are not competing directly with McDonald's because they consider the food much better than what McDonald's offers. So it's a very interesting debate. I think that right now it will be interesting to see how this stock is going to perform because there's been a lot of buzz around the IPO. There's been a lot of excitement. It's a very curious story on itself. For example, the founder is a hedge fund manager. One of the founders, he created the chain with a childhood friend who used to be in wholesale fashion. So it's not like a Mexican family that was like in their backyard in Sydney that decided to create a restaurant. It was a very sharp business model that he saw back then, and now we are seeing a quite successful IPO. If they're going to stick to those plans, they're going to deliver all of those new shops. If people are going to keep buying the burritos in Sydney, in Tokyo, in Singapore, well, I think that's the next question,
37% first day of trade. Felipe Pacheco, their equity capital markets report. I know exactly what we're having for lunch. Guaranteed. 10 minutes before the show ends, get those orders in. I want them on my desk in 15 minutes from now.
Yeah, we just want some guac now.
Yeah.
Chips and guac. Something simple.
Let's get the show over with.
Anyway, ahead. This is Bloomberg. Welcome back. Here are some headlines that we've been tracking in Asia today. U.S. intelligence sources say they believe China's leaders have no clear favorite between Joe Biden and Donald Trump and their likely presidential election rematch. The U.S. assessment is matched by interviews with Beijing officials who think both candidates are intent on containing China. While Trump has threatened higher tariffs, Biden is seen pushing regional alliances against China's rise. Lawmakers in Taiwan are beginning a new round of debate over a bill that critics say is aimed at reining in President Lai Ching-te. The measure would expand the power of lawmakers to investigate government projects and policies. The move brought protesters out on the streets again, similar to scenes that we saw last month. Those demonstrations were some of the largest in Taiwan in decades. In Japan now, some officials are considering charging higher prices for foreigners as the country grapples with a flood of overseas tourists attracted by the cheap yen. So I'm guessing most of us who have traveled to Japan since the borders reopened are going to be affected by this in some way, right? Because there's been concerns of over-tourism in the country, and you're starting to see some of these cities saying, look, I'm just going to charge you more. Because I don't want these big lines. There's been reports of bad behavior. But yeah, it could get a bit more costly.
Views getting blocked because it's become, right? This one was the one in headlines.
The lawsuit, right? Yeah, where they basically, there were too many tourists coming up to go see, what was behind them, which was the Fuji Mountains. So they built a whole sort of barrier just to stop. But I don't think that even stopped that many tourists from
No, I think they're
going.
now taking a picture of the actual...
Of the actual barrier.
Yeah, of the actual barrier. But yeah, I mean, a tax on tourists or a tourist tax is nothing new. And I guess this is really a story about capacity.
Yeah.
Right? And them being able to make it, and still a good experience for everybody else. I just checked. There are actually 5 locations in Japan of Guzman y Gomez.
So maybe we should go there.
So we should go there instead and take advantage of the cheap yen and burritos. My head is still on that IPO, that big listing over in Australia. Speaking of big listings, the star market, very quickly here, on the back of policy pronouncements or perhaps more support for this market, seeing some upside in the cash market, the cash markets right now. There we go, in some of these names. On the back of the government, of course, in supporting perhaps some M&A in the region. All right, that's it from us here at the China Show. Bloomberg Markets Asia is next. Time for lunch, I think, and I smell. This is Bloomberg.